Have you noticed that more and more new investors are jumping into the stock market lately? However, there is no doubt that the stock market is a difficult place and that beginners can make many mistakes. In this video, I've listed the 10 most common mistakes and we'll talk about how to avoid them. I've made many of these mistakes myself and know from experience that these approaches don't work. So let's discuss some common pitfalls to avoid at all costs. Let's get started. Mistake 1. Owning too many accounts. When you start investing, it might seem like a good idea to open multiple accounts with different companies to try and make the most of your money. However, this can quickly become confusing. Imagine having 3 different retirement accounts with 3 different firms, money left in old job accounts, and savings at several banks because each offered a slightly better interest rate. While it shows you're keen to save and invest, managing too many accounts can be overwhelming. You might lose track of what you have and where it is. It's like having too many remote controls. Instead of making life easier, it complicates things. To keep things simple and ensure you always know your financial standing, consider consolidating your accounts. This way, you can easily monitor your investments and avoid unnecessary fees. Mistake 2. Paying too much in investing fees. Investing fees might seem small, but they can eat up a big chunk of your earnings over time. When you invest, whether in mutual funds or retirement accounts, you pay fees for managing those investments. These fees are often a percentage of the money you have invested, and they can vary a lot. For instance, if a fund charges 1% per year, and you have $10,000 invested, you pay $100 every year just for owning that fund. Now imagine if you're paying higher fees like 2%, that's $200 every year on the same investment, which adds up, especially over many years. To keep more of your money working for you, it's smart to choose investments with low fees. Index funds, for example, typically have much lower fees and can be a great choice for keeping costs down while still getting good returns. Mistake 3. Paying too much in taxes. Nobody likes paying more taxes than they need to, especially when it comes to your investments. By using accounts that give you tax benefits, like a 401k or a Roth IRA, you can keep more of your money. When you invest in a 401k, the money you put in lowers your taxable income, saving you money on taxes now. The investment grows without you having to pay taxes on the gains each year. With a Roth IRA, although you pay taxes on the money you contribute right away, you won't owe any taxes on what it earns over the years when you take it out in retirement. Also, there's a health savings account, HSA, which offers triple tax benefits. Your deposits are tax deductible, the money grows tax-free, and you can spend it tax-free on medical expenses. Smart use of these accounts can reduce how much you pay in taxes, making your money work harder for you. Mistake 4. Designing overly complex investment portfolios. Creating an investment portfolio that's too complicated can actually make it harder for you to manage your money and understand how your investments are doing. Some people think that by having a wide variety of investments, they're spreading their risks and increasing their chances of making more money. They might split their investments across many different types of stocks and bonds, or even different sectors and countries. However, keeping it simple can be just as effective. Often a straightforward portfolio that includes a mix of stocks and bonds, covering broad market indexes, works very well. This simpler approach can reduce your stress and costs because it's easier to manage. It also helps you stay focused on your long-term investment goals without getting distracted by too many details. Remember, investing isn't about being fancy. It's about being smart and consistent to help your money grow over time. Mistake 5. Forgetting to reinvest dividends. Dividends are extra money companies pay to their shareholders, often as a reward for owning their stock. Instead of spending this money or letting it sit idle in your account, it's a smart move to reinvest it. Reinvesting dividends means using that money to buy more shares of the stock or fund you own. This helps your investment grow faster because you're making use of every dollar. Some people forget to set their accounts to reinvest dividends automatically, so the cash just sits there doing nothing. Over time, this can add up to a lot of missed opportunities for growth. To avoid this mistake, log in to your investment account and make sure dividends are being reinvested. By doing this, your money keeps working for you, and you benefit from the power of compounding, where your earnings generate even more earnings. Mistake 6. Paying too much attention to market news. It's good to stay informed about what's happening in the stock market, but spending too much time on market news can be harmful to your investments. News articles and headlines are designed to grab your attention, often focusing on short-term changes, like a stock going up or down, or what's happening with interest rates. This can make you feel like you need to act quickly and adjust your investments, but reacting to every bit of news can lead to poor decisions. Remember, the market goes up and down all the time, and these changes often don't matter in the long run. Instead of focusing on daily news, stick to your long-term investment plan. Keep in mind that patience and consistency are more important than trying to predict or react to market movements. The less you stress over short-term news, the better your results will likely be. Mistake 7. Chasing higher returns. Many new investors make the mistake of constantly trying to beat the market by chasing higher returns. They buy and sell stocks, switch mutual funds, or try to time the market by predicting when prices will go up or down. While this might seem like a good way to grow your money faster, it often leads to more losses than gains. The truth is, no one can consistently predict which stocks or funds will perform the best in the future. Companies can change, and even the best fund managers don't always succeed in the long run. Instead of chasing returns, focus on what you can control, keeping costs low, minimizing taxes, and investing regularly in a diversified portfolio. Staying consistent and patient with your investments will help you build wealth over time without unnecessary stress or risk. Slow and steady wins the race in investing. Mistake 8. Being too conservative. Playing it safe with your investments might seem like a good idea, especially if you're afraid of losing money. But being too conservative, like keeping most of your money in savings accounts or bonds, can mean missing out on higher returns from stocks. This is especially true if you're young and have many years to invest. Stocks may go up and down in the short term, but over time they tend to grow more than bonds or cash. If you're too cautious, your money might not grow enough to meet your future needs, like retirement. For example, putting all your money in bonds might only give you a 5% return, while a mix of stocks and bonds could double that. It's okay to be careful, but don't let fear hold you back from taking smart risks that can help your money grow over the long term. Mistake 9. Not being patient. One of the biggest mistakes investors make is expecting quick results. Investing is like planting a tree. It takes time to grow and bear fruit. Many people get impatient and want their money to grow overnight. This leads to chasing get-rich-quick schemes, falling for market bubbles, or selling investments too early. But the truth is, good investing takes years of patience. For example, the stock market may go up and down in the short term, but over the long term it generally grows. If you panic and sell when the market drops, you lock in losses instead of waiting for it to recover. Patience allows your investments to benefit from compounding, where your earnings grow on top of previous earnings. Remember, successful investing isn't about making quick moves. It's about staying steady and giving your money time to grow. Patience is key to building long-term wealth. And now we come to the last and biggest mistake. Mistake 10. Forgetting to invest in life. While growing your money is important, focusing too much on investing can cause you to overlook what really matters in life. Things like your health, relationships, and happiness are just as valuable, if not more. You could have the perfect investment portfolio or millions in the bank, but if you're not healthy or don't have loved ones to share it with, it might not feel rewarding. Spending time with family, enjoying hobbies, and taking care of yourself should be a priority. Money is just a tool. It helps you live comfortably and gives you freedom, but it's not the goal itself. Balance is key. Once your finances are in order, take time to enjoy life and build meaningful connections. Remember, wealth isn't just about money. It's also about having a life full of joy, purpose, and great memories. That's the real return on investment. Now that you know all of them, please write a few down and post them on your wall. Thank you for watching. If you found these tips helpful, don't forget to like this video and subscribe for more content on smart investing and financial growth. See you in the next one.